Hello everyone, Clifford Bennett, Chief Economist at ACY Securities. I hope the world's being kind to you and markets are as well. A lot going on, but I think the number one standout feature of markets at the moment is that US equities, all very hopeful about the debt ceiling resolution. It looks likely that will happen, but at what pace we're still not completely clear. There could still be a technical default, and I'll call it a technical default, like a technical recession on June 6th if this bill doesn't come into law in time. But if it's close to being signed off by the president after passing Congress and the Senate, then I don't think anyone's going to worry too much about that. Worry about it, but won't change investment decisions. So therefore, the market should be firm now, especially as the Federal Reserve has come out, or various Fed presidents and even Jerome Powell previously. You know, they've strongly intimated now that the Fed will be on hold at this meeting. I thought that would be the case for a while, but that inflation data being so strong, you never know, it could still be a rate hike. But what I think is going to be the most important factor going forward is not the US debt ceiling, but the actual level of US debt, because we all know it jumped 25%, 30% during COVID and is now going ever higher, and it's about to surpass 130% of GDP, which is an alarming level. Also, the debt ceiling's only been kicked down the road for 2 years, so will remain a problem, and none of the core issues of the US economy are really being addressed in this issue at all. So I don't think it's all that favorable, because if the market was going to get truly excited by a resolution of the debt ceiling, it would be doing a lot better than it is at the moment. The price action looks very tired overall, and I do think there have been some bubble moments in some particular stocks that may begin to be unwound at the moment. On the bond yield, the yield will drop just a little bit more, but long term the yield will be going up, because as soon as the debt ceiling is resolved, the US government has to go and borrow an awful lot of money very, very quickly, and that could again be driving bonds lower in price, higher yields. US dollar is a mixed bag, because the higher yield outlook, and particularly even though the Fed is going on pause, it's going to stay at current levels or move higher later in the year, is also a factor that's coming into play to support the US dollar, as well as the kind of general dismay, I think, among many US corporations who are bringing funds back from overseas again into the US, particularly as in the US, these major global corporations, it may be a more complex tax issue, but their deposits are fully 100% guaranteed. Any cash deposits they have with those major too big to fail banks. So the US dollar can be firm even in a crisis situation in the United States, and we've seen that several times before. In China, as forecast, the economy has rebounded. I think the post-COVID boom recovery phase is already finished. So we're going to see steady, firm economic growth in China moving forward. But as I've always said, been saying constantly to you for the last couple of years, not at the previous breakneck speed that used to be the case. And all forecasts of returning to those kinds of levels of growth were really grossly inaccurate and just failed to take into account that the Chinese economy is now close to being a mature consumer capitalist economy. It doesn't have a fully democratic government as the way we see it, has a one-party democracy, but the economic system itself, a lot more state intervention happening at this point, but still very much a laissez-faire, if it can be, economic situation. But really what it's about is that we've seen tremendous intra-regional growth amongst trade, amongst the various nations of Asia, and growing at 25% in recent years. So that intra-regional growth is also maturing a little bit, and so China's own internal economy, second largest in the world, is maturing, and the spurt of intra-regional growth as Asian countries came into their own, if you like, without necessarily needing to be able to export to Europe and the United States as much as they once did, that intra-regional fervor is also beginning to mature a little bit. So we're looking at strong and steady growth throughout Asia, China, Asia going forward, but not at the previous breakneck speed. And so therefore, there might need to be some recalibration of that in markets for the long-term outlook. Speaking of the long-term outlook, just quickly back to US Fed funds rate. Federal Reserve's increasingly aware of the banking crisis that continues to build in the background. I do believe we're going to see many more bank failures in the US. I do believe we're going to see a systemic problem in regional banking in the United States taking hold. I think the Federal Reserve is very much aware of that. And so, whilst I've been expecting the Fed to hike at every second or third meeting for the rest of this year because inflation is just going to stay way beyond most people's expectations, and they don't mind hurting the economy as such, they are now starting to really, their emotions are starting, their nervous system is starting to respond to the fact that there is a very significant banking risk, systemic risk occurring in the United States now because of that policy of only the too big to fail banks will have their deposits fully guaranteed. So the Fed beginning to really recognize that. And remember, on previous occasion, they raised rates even as they just had their second biggest bank failure in US history. They still raised rates because they wanted to say to the market, we're confident in the banking system. Well, I don't think they're that confident anymore, and I think they can see these problems now themselves. And so even though inflation could stay high and go even higher from where it is at the moment, particularly core inflation and services inflation and a wages prices spiral to the upside has already taken hold in the United States. Even with all that, it has been the most aggressive rate hiking cycle in history, and this banking crisis and the tightening of credit that will cause throughout the economy is probably going to be enough to make the Fed decide to err on the side of caution and sit pat on interest rates. So what I'm saying is, if there is a risk to my central scenario previously of a rate hike every second or third meeting by the Fed through the end of this year because of high inflation, if there is a risk to that hawkish scenario, among the most hawkish in the world, then it is that the Fed could go on hold at this meeting, and then the banking crisis begins to percolate, come to the surface, and explode into the atmosphere, the economic atmosphere. And in that case, we could see the Fed stay at the current rate setting for the next 12 to 18 months. They won't be able to drop rates because inflation will stay too high, but they won't want to hike rates because they have a slowing economy and a paralyzed political system in many ways, and they have this banking crisis, and they have private sector tightening of credit, which could become extreme. So the US economy could still be going into recession with high inflation and a banking crisis. So if it was going into recession with high inflation, the Fed, I think, would still hike every second or third meeting. But if it's going into recession with high inflation and a banking crisis, then the Federal Reserve may stay on hold for the foreseeable future. But even that is a dire predicament for the US stock market. Now, everyone's talking about historical averages for valuations of US stocks. This is not a historically average time. You know, manufacturing's in recession already. The building industry's, really in trouble. Services, retail's not doing as well as a lot of people think it is. So the US economy is in a lot of trouble right now, and I think it's definitely going to have way below trend growth, perhaps recession in the second half of this year or going into next year. These problems are not going away next year. All of these problems I'm talking about are going to be there next year as well. So I think you have to say, not where stocks are a good buy because they're at average historic valuations or only slightly above. They should be way below the average of historical valuations, because the US has never been confronted, and regulators and the administration have never been confronted by such a complex and difficult storm, economic matrix storm, as exists today. So I would be very wary of getting too excited about the US debt ceiling being resolved, the bill being passed. You may see some knee-jerk reaction in markets, but most big money managers out there, I believe, are starting to recognize the global economy is not going to be as strong as they thought it was. We've forecast all along it wouldn't be. And that the global economy is still going to be drastically slowing as China underperforms and the United States underperforms, and Europe will again be underperforming. So they're the three big major economic units, But of course, the rest of the world's coming of age as well. And there are plenty of opportunities around the world, but not necessarily in those big, previously safe economic environments. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.